Can a trust really help you avoid income tax on passive or maybe even active income? I know a lot of people on the internet will tell you it can. The answer is that it can't. Hi, I'm John Strohmeyer with Strohmeyer Law, where we help our clients leave no unfinished business. While I am an attorney, I'm not your attorney, so make sure you talk to your own advisors about your specific situations. Don't just take some advice from a talking head on the internet. Now, today we're going to be talking about 643B trusts, or sometimes referred to as non-grantor, complex, irrevocable, discretionary spendthrift trust. They go by different names, but the point is always the same. People are promoting these trusts in the hopes that they can get you into not paying any income tax on things that you've earned. The reality is that the Internal Revenue Code is pretty clear. There's no way to defer income that is received by a trust. That income is going to be taxed in the year that it's received. There's not going to be any special deferral outside of some special charitable trusts. But the point is, a non-grantor, irrevocable, complex, discretionary spendthrift trust isn't going to be a method for avoiding income tax. That tax will have to be paid as it's earned. You're running into a headlong fight with the IRS where you're not going to be on the good side of the law with this. So let's get into it. There are a lot of claims out there, and basically I'm going to treat this as a chance to respond to those claims that are put out by their promoters. In 2023, the IRS released Memo 2023-006. It walks through the claims made by some of the promoters, not all of them, some of them get to pick and choose their claims, and then walks through the law and shows how these trusts, which are relying on a misreading of Internal Revenue Code Section 643B to try and achieve some tax-free results. While this is presented as a measure to curb perceived abuses, the memo rests on mischaracterizations of both statutory law and constitutional limits and fails to account for decades of established fiduciary principles and judicial precedent. Its conclusions, particularly those that suggest that all gross receipts in such trusts must eventually be taxed, are in fundamental tension with the foundational doctrines of trust law, the Internal Revenue Code, and the U.S. Constitution. Well, the problem is that as we walk back and look at this claim, the Internal Revenue Code makes a distinction between fiduciary accounting income principles and income taxation. And this is the big part of what we're looking at. Internal Revenue Code Section 641 addresses taxation of income received by the trust. That determines what is taxable to the trust. 643 deals with distributable net income and what can be generated as a deduction because it's been passed out to beneficiaries and will be taxed there. We've got a whole separate video on distributable net income, DNI, so I'll touch on it here and there, but I won't be going into as deep of a dive. Now, let's get into some of the misleading and legally inaccurate claims there. Well, first, the IRS memo doesn't mischaracterize statutory law. It's applying it precisely. Now, Memo 2023-006 is based squarely on IRC 641A, which imposes income tax on the taxable income of a trust, not its fiduciary accounting income. As clarified in 641B, a trust's taxable income is calculated in the same manner as an individual, with specific modifications that do not include a blanket exclusion for income simply because it's being allocated to corpus or principal. Again, when you get into 643B, that's where that corpus, the allocation between corpus, income, or corpus and principal, depending on which verbiage you prefer to use or what's used commonly in your state, that just doesn't matter. If it's taxable income, it's taxable to the trust unless it's being distributed out to a beneficiary. So the promoters of these trusts generally try and cherry pick phrases from 643A and 643B, which are defining distributable net income, DNI, and fiduciary accounting income, respectively, and then conflate them with taxable income under 641. This is a fundamental error because fiduciary accounting allocations to corpus may affect whether income is included in DNI, which then governs how much can be taxed to beneficiaries. But that has absolutely nothing to do with whether the trust itself is going to owe tax. Income not distributed to a beneficiary is therefore taxed at the trust level under 641. Here's our next thing. There's no conflict with decades of fiduciary law or precedent. The memorandum from the IRS doesn't conflict with those fiduciary principles. In fact, it respects them by acknowledging that trustees have the authority under both state law and the governing trust instrument to allocate things like capital gains and certain other forms of income from income back to corpus under existing trust law. Again, allocating income to corpus under local law accounting rules does not exempt it from federal income tax. Again, this is the crux of what they're relying on. You can't take something, wave a magic word wand, and turn it into non-taxable income. And so this distinction really is pretty clear. Accounting income determines what is distributable to current income beneficiaries. Taxable income determines what is reported and taxed on a federal income tax return. This has been true for decades and is entirely consistent with all of the judicial precedent and structure of Subchapter J of the Internal Revenue Code. So when you see someone quoting a case that says, well, the trustee has the authority to do this, nobody's disagreeing with that. What we're disagreeing with is that allocation somehow magically turns taxable income into non-taxable or deferrable income. Next up, there are no constitutional violations. Now, there's no constitutional right to dodge income tax by manipulating accounting definitions. Of course, we all know that everybody has the right to plan in such a way that's within the bounds of the law to minimize their tax burden. You don't have an obligation to maximize the tax that you send off to the government. And Congress has the authority under the 16th Amendment to tax income from whatever source derived. That taxability of trust income under 641 is a long settled application of that power. I'm still waiting for them to provide a case that shows that taxing retained trust income, especially capital gains and dividends, is unconstitutional. And there are no credible legal bases for treating these trusts as exempt from income tax simply because the income is allocated to corpus. Again, there are charitable trusts that have different rules, but ultimately that income is either being taxed when it's distributed to a beneficiary, or otherwise it's being deferred and then it's being held inside of a tax-exempt vehicle. But there are all sorts of other rules that apply to those charitable trusts that we're not getting into. A normal complex trust or a non-grantor trust, those things mean the same thing. They're required to report and pay tax every year using Form 1041. And you can't just allocate all that income to corpus and then generate a deduction. That's just beyond the scope of what the IRC allows you to do. So bringing this little section to a close, the memo from the IRS has conclusions that are consistent with the law. That memo, 2023-006, simply reaffirms a basic point. Trusts must report and pay tax on their taxable income unless that income is properly distributed and deductible under 651 or 661. The memorandum carefully distinguishes between what can be excluded from D&I, which affects trust deductions, versus what constitutes taxable income under 641, which governs whether or not the trust is paying any tax. Simply put, there's no support anywhere in the code that allows a trust to avoid income tax solely by allocating gross receipts to corpus or principal. Period. The end. The next claim is that the IRS is somehow attempting to blur a line between income and corpus, which would undermine all of estate and trust planning. And if they did this, well, non-grantor, irrevocable, complex, discretionary spendthrift trusts, which are normal tools that are used in estate and gift tax planning. I mean, I use them all day long. We would somehow unwind all of these. Well, this just isn't true. These claims are misrepresenting both the structure and function of Subchapter J of the Internal Revenue Code and how fiduciary accounting interacts with federal tax law. So let's get into the issues of how the IRS is being accused of blurring the lines. First, allocating income to corpus may be permitted under fiduciary accounting principles, but it does not exempt that income from federal income tax. Yes, trustees are fully allowed to allocate certain types of income, like capital gains or extraordinary dividends, to corpus under fiduciary accounting rules. Beyond that, if the trust agreement allows them, they can allocate almost any sort of income back to corpus when the governing instrument and applicable state law allow it. This has always been true and is clearly acknowledged in 643B. But that accounting allocation doesn't change whether the income is subject to federal income tax. The distinction is being blurred here is not by the IRS, but by promoters claiming that allocating income to corpus somehow avoids taxation. So our bottom line here is that by allocating to corpus, you might keep income out of distributable net income and therefore off a beneficiary's Schedule K-1. But it will not remove it from the trust's taxable income under 641. The next claim is that taxable income is actually defined independently of fiduciary accounting rules. The Internal Revenue Code is really clear on this point. 641A imposes tax on the taxable income of a trust. 641B states that the taxable income is computed in the same manner as in the case of an individual. Moving over to 643B, well, by contrast, it's defining accounting income for the purposes of determining what gets distributed, not for determining tax liability. The reality is, the IRS doesn't care what gets allocated between fiduciary accounting income and fiduciary accounting corpus. It's all taxable. If it's all accounted to corpus, guess what? There's nothing that's going to be included in distributable net income. And then under 641A, all of that included income is if it's taxable income, is taxable to the trust. Promoters are trying to claim that because a trust can call certain receipts corpus under state law, that somehow makes them invisible to the IRS. That's false. And even if they're not claiming exactly those words, well, the IRS doesn't care what you call income. It cares about what is taxable income under federal tax rules. It's important to remember that sophisticated trusts still follow federal tax law. So non-grantor, irrevocable, complex, discretionary spendthrift trusts can be used in legitimate planning. There's nothing wrong with this. Again, we're setting these up all the time, but they are not immune from income taxation. In fact, they are separate tax-paying entities and must report and pay tax on all income they receive every year unless it's either distributed to beneficiaries and deducted under 651 or 661, or it's otherwise excluded under a valid provision of the code, which does not include the trustee waving a wand and saying it's corpus, or the trustee signing a document and saying, I allocate thee to corpus, and therefore you are tax-free. It just doesn't work that way. Trustees may be sophisticated. The trusts can be complicated, but the complexity doesn't override the basic requirement to pay income tax under 641. There's nothing in Subchapter J that allows for some sort of lawful tax deferral mechanism for passive income simply because it's been allocated to corpus. If a trust receives $100,000 of dividends and rents and distributes none of it, then poof, that's going to go on the 1041, and the trustee is required to pay tax on that at the trust level. What promoters are calling deferral is really an attempt to pretend that the income didn't exist or somehow they can generate a deduction under usually 67E for tax purposes, not because of an election or a deferral provision in the code, but because of an accounting label. That's just not how tax law works. Finally, when it comes to this claim, this isn't about undermining estate planning. It's about upholding the law. The IRS is not attacking legitimate trusts. It's addressing a specific abuse. The idea that trusts can receive taxable income, label it corpus or principal, and then claim no taxes due. That's not tax planning. That's misrepresentation. Legitimate estate planning uses these trusts alongside compliance with Subchapter J. What's being marketed by these promoters is a distortion of the rules that would, if accepted, allow high-income taxpayers to launder passive income through paper trusts without ever paying tax. That doesn't preserve any integrity in estate planning. It's burning it down. The next claim is that Internal Revenue Code Section 643B and applicable regulations provide trustees with the authority to classify extraordinary dividends and similar receipts as principal. If they do this in good faith, well, then in compliance with the trust instrument and relevant fiduciary law, it places that income outside the scope of DNI. Because DNI serves as the conduit through which trust income is passed to beneficiaries and subsequently taxed, any receipt not included in DNI is therefore excluded from current income taxation. The problem is this claim misunderstands DNI and the broader framework of federal income taxation for trusts under Subchapter J. So let's get into it. As a reminder, what is DNI? Distributable net income is a tax concept defined in IRC 643A. It serves two key purposes. First, it limits the trust's income distribution deduction, which is the amount that a trust can deduct on its own tax return when it distributes income to beneficiaries. It also caps the amount of income that beneficiaries must report as taxable when they receive distributions. So you can think of DNI as an upper limit on the amount of taxable income that can pass through from the trust to the beneficiary. It doesn't control whether or not the trust is taxed itself. So if nothing goes out, if that upper limit is set to zero, then guess what? That taxable income is taxed to the trustee. So if income is not included in DNI because it's been allocated to corpus, then it is not deductible to the trust and therefore taxable to the trust under 641. Now, again, allocating income to corpus affects accounting, not taxability. Yes, 643B and appropriate regulations allow a trustee acting in good faith and following the terms of the trust and appropriate state fiduciary law can allocate extraordinary dividends and taxable stock dividends to principal instead of to income. They can also do this for regular old income, um, ordinary dividends, interest, rent, things like that. That then means that they're excluded from DNI. But this is, again, the key mistake that they're making. Just because an item is excluded from DNI, it does not follow at all that it is excluded from being taxable income. This is their misunderstanding. DNI is not the same as taxable income. That income might not pass to the beneficiary and thus not appear on their Schedule K1. But unless there's a specific exclusion that they can point to in the code, and they can't, it is taxable to the trust and not to the beneficiary. So we get to our next point. The trust still owes tax on the income it retains. If the trustee retains those extraordinary dividends and allocates them to principal, they are excluded from DNI, which is what we expect. The trust cannot deduct them as a distribution because it didn't. Third, that income stays on the trust form 1041, and then the trust will pay income tax on that extraordinary dividend. This is exactly what 641 is making clear. The tax imposed by Section 1E shall apply to the taxable income of estates and any kind of property held in trust. Following then in 641B, the taxable income of a trust shall be computed in the same manner as in the case of an individual, except as otherwise provided. 643B ain't doing that for you. There simply is nothing in 641 that says income becomes non-taxable simply because it was classified as principal. That classification is only applicable to DNI, not gross or taxable income. So trustees have the power and the discretion to allocate between income and principal, but not the power to exempt income from taxation. They have all sorts of discretion under fiduciary law to allocate receipts to corpus or principal. That is fiduciary accounting income and ultimately the calculation of DNI, but it doesn't remove those receipts from the trust's gross income under Section 61 or exempt them from tax under 641. The trust is a separate taxpayer. If it earns income and does not distribute it, it pays that tax. So trying to treat DNI as some sort of gatekeeping concept for taxability misunderstands its role entirely. DNI is about who pays, not whether anybody does pay. Our next claim is that IRS Memo 2023 006 is somehow escaping reality by assuming that gross income that is received by a trust must be taxed at some point, regardless of whether it had been allocated to corpus or principal. They continue that this underlying mistake ignores how non-grantor, irrevocable, complex, discretionary spendthrift trusts have been set up, which, because of their design, create no DNI and don't make any distributions. And as a result, there's no taxable income. So if there's no distributions of DNI that can occur, then income is never taxed either to the trust or its beneficiaries. Now, as we step away from that claim, it's really just incorrect and fundamentally, again, misstates how trust taxation works under the Internal Revenue Code. First and foremost, the memo isn't assuming that income is taxed at some point. It's applying the law that requires it to be taxed when it is earned. The memo doesn't make an assumption. It's following 641A, which is imposing tax on the taxable income of trusts. 641B says that that income is calculated in the same manner as in the case of an individual. That means when a trust earns gross income, dividends, rents, royalties, capital gains, and so on, it's taxable in the year it's earned unless either it qualifies for a specific exclusion under the code, such as tax-exempt municipal bond income, or it's properly distributed and deducted as part of DNI under 651 and 661. There is no third category that allows income to vanish from the tax system simply because it's been labeled as corpus. So The trust that doesn't create D&I is not a loophole. It's an admission that the trust pays the tax. The claim that our non-grantor, irrevocable, complex, discretionary, spendthrift trusts do not create D&I and do not make distributions that carry out taxable income is not a tax avoidance strategy. In fact, given current tax brackets, it may be one of the worst tax strategies because it's forcing the trust to pay tax at its compressed ladder rates, at which are much higher than an individual. So it's the exact situation in which the trust is going to pay the full tax bill and possibly pays even more. So if there are no distributions that are made and no D&I exists, there's no deduction available to the trust under 651 or 661. It also means that 100% of the trust's taxable income is taxed at the trust level. This is exactly what that memo is explaining. You can't deduct what you do not distribute, and the trust pays tax on all retained income. That D&I mechanism is there to shift the tax liability from the trust to the beneficiaries when the income goes out the door. No distribution means no shifts, and the trust pays tax. That's not a loophole. It's how the code was designed. It's a single layer of income tax that's allocated between the trustee and the beneficiary, not some other way of doing it to where there's no tax unless it hits the beneficiary. Which means dispersing only principal doesn't remove tax liability either. So even if the trust only makes distributions of assets classified as principal, so things like property originally transferred to the trust or even income allocated back to principal, it's not going to change the fact that the income earned and retained by the trust remains taxable to the trust. So the promoters of these trusts are often blurring fiduciary accounting classifications, again, income versus corpus or principal, with federal tax consequences. This is the crux of their scheme, and it's legally invalid. The memo says explicitly, contrary to the claims of the promoters, the trust will recognize income on its capital gains and dividends, except to the extent that those amounts are distributed or deemed distributed to the beneficiaries. There's no code section that says income is only taxed if it's distributed. It's just a misreading. And so we come back to this same point. This scheme is violating basic tax policy. The suggestion that income can be earned and permanently excluded from the tax system by being allocated to corpus, not distributed, and not included in D&I amounts to an attempt to launder taxable income through some accounting labels. And I know there are things that a lot of us don't get why they're non-taxable, but this ain't one of them. If this were allowed, any taxpayer could form a trust, route income through it, label it as corpus, and avoid tax forever. Congress explicitly blocked this kind of abuse with Subchapter J, requiring either trust level taxation under 641A or beneficiary level taxation upon distribution under 651 to 662. So, in conclusion, income isn't going away just because it's been allocated to corpus. Federal tax law, not trust accounting rules, determine what gets taxed and when. If a trust earns income and does not distribute it, the trust owes the tax. The claim that our non-grantor, irrevocable, complex, discretionary spendthrift trusts can avoid all income tax by waving their magic wand and avoiding D&I and making only principal distributions is both legally incorrect and explicitly rebutted by 2023-006, which is based on the Internal Revenue Code and applicable case law. So you're not going to be able to label income as corpus and exempt it from tax. It just means that the trust, not the beneficiary, will be writing the check. Now, we've gone through a lot of these claims, and the reality is there are a lot more claims out there. We've spent a lot of time going through them today. We're going to come back and we'll talk more about some of the other claims that are out there. We're sadly just getting started on this. So don't forget to like, comment, and subscribe, and we'll see you next time.